Good morning from London. This is Bloomberg Markets Today. I'm Anna Edwards alongside Guy Johnson and Chrissy Gupta. With the cash trade just less than an hour away, here's what you need to know. Tesla shares soar as investors cheer Elon Musk's promise of making cheaper cars sooner. Investors overlooking a big miss on earnings. We'll discuss results from Volvo Cars with that company's CEO shortly. Kering's ADRs slump after the company warns profit will plunge as the crisis at its biggest brand, Gucci, deepens. We'll bring you more on European earnings with Heineken and Lloyds Banking Group both reporting. Plus, President Biden says fresh U.S. military aid will start flowing to Ukraine within days after the Senate passes a long-delayed aid package. We'll bring you the latest ahead of Anthony Blinken's visit to China.
In the meantime, a quick check on these markets here. When you look at the futures action, you are seeing green on the screen yet again. Eurostoxx 50 futures higher by 0.5%. For me, it's all about this bond market, though. Even though you aren't seeing much movement this morning, a really interesting auction at the 2-year yesterday over in the States, 492. We're going to dive into those dynamics. But you are seeing some strength in the European currencies as well. Euro dollar 107.04. Cable at 124.56. Markets today starts right now.
Good morning, everybody. Wednesday the 24th. We've got a lot to talk about this morning, and it's mainly kind of bottom-up rather than top-down. We spent a lot of time recently doing a lot of macro news. Today, we're going to do a lot of corporate news. We are in the thick of it. The earnings season over the next few days is really going to gather pace, and it picks up this Wednesday in some style. We've already had numbers out this morning from Volvo Cars. We're going to be talking to its CEO very shortly. This on the back of course, what happened with Tesla last night. But this morning, we get Heineken, we get Lloyds, we get Reckitt. The Reckitt numbers look already quite good. Lloyds looks like it's ahead of expectations. We need to dig into the net interest income line there. And we've got Heineken this morning.
Yeah, absolutely. Where to start? Let's go with Heineken, shall we, as you teed that up then, Guy. First quarter organic beer volumes up by 4.7%. It's better than the estimate. The volume is better than the estimate. The revenue then overall also coming in better than estimates. But we do need to be aware of the timing of Easter, and this is a business that was set to benefit from the shift in the timing of Easter. So again, a little bit of digging beneath the surface perhaps required there. Lloyds also does stand out. Q1 statutory pre-tax profit then at £1.6 billion, that is, ahead of the estimates. No further charges relating to the FCA car loan review. That's going to be of interest to analysts. They've been waiting to see whether there was going to be any further charge on that front. Of course, with Lloyds, we're always looking for any detail around the mortgage market. Such a big player in the mortgage space. What are they saying about demand there, but also mortgage spreads?
Mortgages, the last couple of days, take a look what's happening with the mortgage numbers. They've started to tick back higher again as the market has become more cautious in terms of what the rate outlook ultimately looks like. We're going to talk about Bloomberg economics ideas around the Fed in just a few minutes' time. But I just want to draw your attention to the net interest income line. That does look a little bit light, and this is a line maybe that we can draw through some of these banks as well in terms of what they are telling us. Looks like we've got a new female CEO at Haleon, which is something to note as well in the pharmaceutical space. Consumer pharmaceutical space. And the car numbers out of Volvo, I think, are fascinating. We probably need to talk about Tesla in a bit more detail. Volvo is making a continued and big push into the EV market, which it itself recognises is a slowing market right now, which is a really tough place to be. And what we're seeing in terms of Tesla and its price cutting probably doesn't help that position.
Yeah, the operating income there coming in a little bit weak when you look at those Volvo numbers. To me, though, look at where you're seeing the growth. I'm going to bring it right back to Heineken because we're talking a lot about the consumer today as well with Nestle and Unilever. We'll have a great guest later on in the second hour, I believe, of the show. The Heineken numbers, yes, we talked about the beer volume increase as well. Their net revenue is what's catching my eye because the net revenue is at coming in a little bit light, $6.85 billion. The estimate there was just shy of $7 billion. The organic revenue, though, increasing by 9.4%, almost twice the estimate. The growth story in Heineken, if I remember from 3 months ago when we talked about this last quarter, it really was, again, a U.S. consumer resilience story. He's talked about that weakness in Asia. That was something you saw across all of the drink makers. That is a really big jump for just the U.S. consumer. We'll see if that dynamic still is in play.
And talking of consumer demand, you mentioned Reckitt, the first quarter like-for-like sales at that business up by 1.5%, and the estimate was for a drop there. So that does seem to be much better than had been anticipated. And this is their business that represents all kinds of consumers. They sell everything from painkillers to cleaning products. Infant formula is an area of difficulty for them recently. They recently had an unfavourable ruling in the United States on that front because Mead Johnson is the business they own over in the United States on baby formula. So we're certainly watching for any comments inventory they have there. But they've managed to get rid of all of the sell ratings on their stock. But it has been one of the weaker performers of late on the FTSE.
Our team are definitely on their toes because we're having to bounce around quite a lot in terms of the numbers that are coming here. And we're trying to figure out kind of any lines that we can draw between these stocks that are reporting this morning. I will flag the Lloyd's Q1 adjusted impairment charge, 57 million. Versus an estimate there of 297 million. So that is a significant impact there in terms of the a lack of an impairment charge. So we'll keep an eye on that. The other thing I want to flag as well is Heathrow. Heathrow numbers this morning. Heathrow sees full year passenger numbers this year at 82.4 million. It originally saw that number as being 81.4. They are anticipating more people are going to be flying through the UK this year over at Heathrow. That tells you a lot about what they see in terms of consumer demand, which I think is interesting. Consumer demand continues to be buoyant. You see it in the service sector data that we continue to get.
Yeah.
And that is where the demand continues to come from. And Heathrow just reflecting that as well.
OK, so going on holidays, if people aren't going to be shelling out for EV cars, perhaps. I'm trying to think of the segue into some of the auto things. You've mentioned the Volvo numbers. We will be diving into that in more detail. And we'll be diving into the Tesla numbers in more detail, Critty. A really interesting piece from our colleague Liam Denning asking about, where was the detail? OK, so you're going to accelerate new and affordable models, but where was the detail about when and how? And we're getting close to the time scale for it, and yet not a lot of detail coming through. So that's one of the big businesses that we certainly have in focus this morning.
Yeah, is Tesla still kind of the luxury vehicle that they want? Will they up that marketing budget to apply to the mass consumer? The other heavyweight we should talk about is Kering as well. We're talking about the consumer. The thread that I can draw between the Tesla, the Kering story, even Volvo, is China. What is the China read-through here? We're going to be talking about that throughout the show, especially ahead of a pretty big visit from Anthony Blinken. I believe he's in China at the moment, at the same time that we're seeing over in the States this TikTok divestiture potentially hitting President Biden's desk today, I want to say.
That's just one of the many themes, a number of issues, of course, for him to address around Taiwan, increasingly the South China Sea. We've got a nice documentary piece later on in the programme to play on that, but also chips. All of that tech war very much ongoing. But, I mean, who hasn't been to China? We saw Janet Yellen there not long ago. Blinken's there as well. Yeah, Olaf Scholz.
Olaf Scholz has just been there. There's a nice piece on the terminal this morning talking about how long this kind of warm, cold war can last and whether it gets colder between the United States, Europe and China. The European Union this morning is launching an investigation. We teed this up a few days back, launching an investigation into medical equipment. It just speaks to this kind of ratcheting higher of trade tensions between these various blocs. Be interested to get Volvo Cars' take on exactly whether or not this is their industry needs significant protection, how much protection they do need. The Beijing Auto Show is about to kick off. The Chinese EV makers are on a tear right now, and that's why Tesla, in some ways, is struggling in the way that it is.
And they're being investigated in Europe, and as you say, medical devices now being investigated in Europe as well.
So that's the regulatory front. We got to bring it back to the Chinese consumer, though, because at the end of the day, I think there's still a question, at least from a macro sphere. I mean, yes, I'm macroing it out, which is the Chinese consumer more relevant, or is the Chinese kind of export business and manufacturing kind of government piece of the equation more relevant? And if you look at the luxury space, it seems like it's the consumer, and that's why I think the Kering story is going to be really interesting. How the market reacts at the at the European Open, warning their profit to tumble, but we kind of already knew that. So is this priced in, or is this additional?
One of the interesting lines I saw was from Kering, from an analyst talking about how, from the business themselves, there isn't this middle market in China right now. Well, that's where the weakness at least is. There's a demand at the very luxury end, and then there's demand for much cheaper products. And so trying to find your feet, if you're a business like Gucci, appears to be a challenge. Right, coming up on the programme, a lot to talk about. Heineken beer volumes beat estimates. We'll dig deeper into those earnings and look ahead to Unilever and Nestle results, both of those due tomorrow. We'll be speaking to Celine Panuti of JP Morgan to get analysis of the consumer sector. So don't miss that conversation at 8:15 UK time. Plus, Kering, as Critty's been rightly flagging for us, it's warning that profit will plunge in the first half of the year as the crisis at its biggest brand, Gucci, deepens. We'll get more on the luxury sector with an analyst from HSBC. That's coming up at 8:30 a.m. London time. Up next, though, back to the car themes. Volvo Cars sees demand for its cars accelerating this year as the Swedish manufacturer pursues ambitious goals for EV sales. Some of the numbers look a little light versus estimates. We'll talk to the CEO, Jim Rowan, about all of that next. If you have any questions for our guests, please get in touch. IB plus TV Go, that is the function to call up on your Bloomberg terminal to get in touch with the team. This is Bloomberg.
Good morning, welcome back. 47 minutes to go until the start of equity trading here in Europe. The expectation is that we are going to see something of a pop at the get-go of trade this morning. Looks like France may be something of a laggard. Kering could be one of the factors behind that. But other markets look like they're going to open circa, let's call it circa 1% higher. Maybe I'm being a bit optimistic. 0.5% to 1%, maybe more accurate in terms of the assessment that we're giving it. One of the areas that we are going to be watching, certainly this morning, is the car sector. Remember, the European auto sector is the second best performing sector in Europe this year behind the banking sector. So when we talk about Tesla and we talk about Volvo, that's kind of the context you need to see this in. So Tesla shares up in late trade last night. This after the company promised to accelerate the launch of more affordable models or more affordable cars. Anyway, we'll dig into the details of that in just a moment. First quarter earnings, not exactly that pretty, though. We have seen margins under pressure. Compare and contrast, I would, maybe Tesla's margin with what we saw from GM. And also volumes look like they're something of an issue as well, despite the pricing push that we have seen. Let's dig into this. The market got very excited about the idea that we are going to be seeing new, cheaper cars. This is what many analysts have been calling for. But is that the reality of the situation? Bloomberg's Craig Trudell is up this morning just after spending his evening and night listening to Elon Musk. There seems to be some ambiguity around exactly what we got yesterday. Now, it looks like the share price has taken the glass half full kind of approach to what we heard. And this idea that we're going to be seeing cheaper cars seems to be being welcomed. But are we going to see cheaper cars? And what cars are we talking about?
Yeah, I ended last night's call very proud of our very own Ed Ludlow and Dana Hull. They did a big take earlier this week, taking a look at Tesla. And, you know, just kind of seizing on the line last night that I think got everyone excited in the earnings release. The Tesla referred to accelerating the launch of new models that would, use aspects of this next generation platform that they've been talking about, as well as aspects of their current platforms. And these vehicles would be produced on the same manufacturing lines as the current vehicle lineup. That, to me, has all the telltale signs of they're going to take their existing cars, make them cheaper, apply some of the innovations they've been working on for this next generation platform that they've been talking about that was supposed to come late next year, and just bring it forward, but bring it forward to the existing cars. And I think Musk was both, excited enough about that and speaking positively enough about that, and cryptic enough so as not to keep people from being interested in going out and getting a 3 and a Y. And when asked, are we talking about new cars here, he pointedly did not address the question.
Yes, and our colleague Liam Denning making the point that every time he was asked for more detail on what these new cars might look like, he went on to talk about robo-taxis, and that is where the focus, it seems, for Tesla is. But Tesla has become a preoccupation for not just us, but also for everybody in the auto space. What Tesla has done with its pricing has had an impact on other car makers. So at a time when we're all fretting about that, what did Tesla have to say about about rivals? Did that come up in the call?
Yeah, I was kind of surprised that they very pointedly said, look, we're seeing some of the rest of the industry pull back from fully electric vehicles and pivot to hybrids. And we've been talking a lot about that with General Motors and Ford in the U.S. in particular, sort of hedging its bets a little bit. And Musk came right out and said that, that's not the right strategy in his view. It is interesting in the sense that, of course, part of this is, company-driven, but this is also consumer-driven. You can't make the consumer want an electric vehicle. And so, to what extent, the industry is just, coming to grips with where the consumer is, and to what extent are they sort of settling for a half measure is something that we'll have to parse for months to come.
Craig, great to see you. We'll let you go and get some rest now. Calm down after the events of last night. Craig Trudell, he leads our auto coverage. Thank you very much indeed. Let's turn to another auto maker, Volvo Cars, set to pursue ambitious sales goals for the year ahead for electric vehicles, despite that slowing market, with deliveries expected to jump 15% this year. This is the Swedish manufacturer reports first quarter operating income that missed estimates this morning. Joining us is Jim Rowan, the CEO of Volvo Cars. Jim, great to speak with you. Thanks for the time, as ever. Let's just talk about your expectations for what happens next. You are out this morning with some ambitious goals in terms of what you think you can deliver in the EV space. Yet, as you amp up your expectations, it does seem as if the voltage in this space is beginning to slow a little bit. The momentum, the push in the space is beginning to come down. How hard is it going to be to deliver your expectations into what feels like a very tough EV market right now?
Yeah, good morning. Thanks for the opportunity. So we came off of a very strong year last year, as you know. We had a record year in 23 where we grew our unit numbers by 15%, we grew our revenues by 21%, and we grew our profits by 43%. But we have a very balanced portfolio. We're not just an EV manufacturer. We have a balanced portfolio in terms of those propulsion systems. We have plug-in electric hybrids, we have mild hybrids, and of course we have full BEVs. And we're seeing that growth come from a combination of all of those technologies. And of course, we're in over 90 countries around the globe. We're also well positioned, I think, in the different market segments. We're positioned in the premium segment, which resists some of the price pressures that you see in mass market. But we also have cars in the 30 segment, 40, 60, and 90. We have SUVs, we have wagons, we have sedans, and of course, most recently, we have the MPV. And that really helps give us the confidence that we're going to continue to grow our business by, as we've said, over 15% this year, on top of a record year last year.
Jim, do you think hybrids will outperform EVs in the next year?
I think hybrids has always been strong for us. In fact, one of the XC60 PHEV plug-in electric hybrid for Volvo, that's the best-selling plug-in electric hybrid in Europe and has been for a while. And so that's a great bridge to the full electric future. What we see is that customers, if they don't have the proper infrastructure or they're not quite ready to go full electric, they start with a plug-in electric hybrid, they get to know the technology, they build the confidence, and then their next product is very often a full electric car. So I think it's a very important bridge technology to that all-electric future.
And I know we've talked in the past about the infrastructure that's required around that and where it's plentiful and where it's missing. Jim, thanks for joining us. Good morning. Can I ask you about pricing? We talked a lot about Tesla this morning, and we talked a lot about Tesla over the last year or so, and price drops in various markets. What impact is that strategy from Tesla having on the wider market, on your ability to price?
Yeah, so the market bifurcates into two. You have mass market and you have premium. We operate in the premium sector, and that is far more resistant to some of the price pressures. So we've been very price disciplined. We haven't reduced our pricing. And the simple reason for that is because we've seen very, very strong demand for our products. As I say, we grew revenue 21% last year, and we grew it by 12% this quarter. So, and we grew profits again by 8% this quarter. So we're seeing this strong demand from those loyal customers that are looking for what Volvo offers: safe, sustainable, human-centric technology and fantastic Scandinavian design. And I think that helps differentiate us in the market.
We've also seen the role that incentives play recently, Jim, and some of the latest data out of Europe really shows clear trends when incentives are removed and demand drops. Where do you think incentives are most useful for this sector? Which sort of price points?
Well, you know, in terms of incentives, I think companies need to bring products to the market that don't require government incentives. I don't think it's government's point to incentivize companies to make products. We need to build the products that stand on their own 2 feet and can make money based on the technologies and the cost options that we have available and that those customers can afford. I think where government can help is where they offer incentives for charge infrastructure, for example. We saw that in the Inflation Reduction Act, and I applaud that. And that really helps then build out the infrastructure. But in terms of individual incentives to companies, I think governments have got other things to spend their money on, and I think we need to be self-sufficient in that space.
Jim, it's Creedy in London. We should mention to our global audience that you are joining us from Shanghai, which is quite timely given that we're getting so much commentary from China and even from the United States and the EU about what that relationship looks like. Jim, digging into your numbers here, in terms of vehicles sold, Volvo has about a third of their cars being sold to China. As the rhetoric, the geopolitical rhetoric between China and the rest of the world ramps up, how does that affect your bottom line?
Well, we continue to grow in China. We continue to grow all over the world, but we also continue to grow in China. I think it goes back to that same narrative. One, we operate in the premium sector, and two, we've got various propulsion technologies. And so we don't sell as many electric cars by percentage of sales in China as we do in other parts of the world. And that's because there's so much competition in China, especially at the mass market, that it's very competitive. We don't need to operate in that mass market space. And so the majority of our sales are plug-in electric hybrids, of course, as well as the EVs. but we've entered the China market in the premium sector in EV. That is the EM90, the new MPV, and of course the EX90, again a premium car, which you can see behind me here, will start shipping in the near future to Chinese customers.
Jim, that premiumization argument is something we've heard from a lot of the luxury makers in Europe as well. Kering, for example, of course, operating in a different sector. That's actually turning out to be their Achilles heel, the fact that they are so exposed to that luxury sector. How do you combat that?
Yeah, big difference between luxury and premium. I think people tend to confuse those two. Premium for us is what we bring and what we've brought for almost 100 years to the auto industry. And the premium attributes that we bring is safety. I think everyone would agree that Volvo still holds the mantle for safety. Safety, sustainability, human-centric technology, not gimmicky, but human-centric technology that's put there to add value to the customer. And you know, really elegant Scandinavian design. Those four pillars of differentiation, I think, what sets us apart, and that makes us premium. When you're adding cost to a car that you know chases luxury without adding the premium attributes of really adding value to the customer, then I think you get in trouble. We don't do that.
All right, Jim Rowan, the CEO of Volvo Cars, joining us from Shanghai this morning. We thank you so much for walking us through your company's story. And I think this is fascinating as well, guys, in terms of when he's talking about that premiumization. It's something, again, we've heard from the drink makers as well. He made the point that Kering is perhaps not the appropriate comparison. But we heard this from the drink makers, didn't we?
Yeah, luxury versus premium. He was drawing that distinction, wasn't he? Really,
but also the China exposure.
Yeah, absolutely. And China's certainly a feature of our programming. He was very keen to point out that they operate in one part of the China market and not the other, because we know the threat at the lower end of the China market that the Chinese producers provide. The
Beijing Auto Show is going to be filled with an awful lot of domestically generated cars, and they are on a tear right now. The question is, how far will that tear take them? Does it take them into Europe? Do the European car makers need protection from that huge wave of cars that is coming out of China right now that are very competitively priced? We're not talking about the premium market, we're talking about the mass market. And how far does that ultimately go? It's interesting also, I thought he talked about hybrids. Everybody's struggling here in Europe and in America. Do you want a hybrid or do you want an electric vehicle? A lot of people seem to be going for the hybrid, so he's bigging that up, which I think is interesting. Yeah, I just think that the lack of infrastructure in so many places. Around, you know, are we starting to talk about the car as a product that, you know, some people can financially, some people can own and some people can't, but also just logistically, some people can own and some people can't, and that's just a big dividing line that we haven't really got our heads around yet. But so much of the momentum, to your point, has come from that subsidy story, isn't it? Isn't even Tesla, for example? It's more of a tax credit story historically than it has been kind of consumer demand for EV, at least in the States. And I think that's a really fascinating story that you're going to see in terms of the car space internationally, which would bring up a point that we actually have the Ford CFO joining us. John Lawler will join the close today over in the United States to discuss the car maker's latest results. You don't want to miss that interview coming up at 9:10 p.m. London time, 4:10 p.m. New York. And as we're talking about perhaps the Asia dynamic as well, it's worth mentioning that as we were speaking to Jim Rowan, dollar yen inching closer and closer to 155. We're at 154.89 at the moment. Does 155 trigger some sort of panic? Right. Does it trigger some panic? Does it trigger some intervention? We've been talking about the BOJ, of course, it's rapidly approaching on Friday, not expected to change. But if there is no change, what does that do to the willingness to intervene? Yep. We're going to watch this very carefully. I'm going to see exactly if there's a read across from Tesla as well into the Magnificent Seven. We do have a lot of the Magnificent Seven reporting over the next few hours. We need to tee you up for that. We're discussing it next. This is Bloomberg. Welcome back to Markets Today, 30 minutes from the start of today's trading session. Let's take you through what we've got on the markets right now then. European equity market futures pointing to a fairly strong open this morning, or pointing a little higher in the case of the CAC 40. Certainly there'll be a luxury effect that might weigh on the French market, so we'll certainly watch that post those Kering numbers and the new guidance we got around profitability there, ongoing concerns at Gucci. But the broader story is around tech, and the Asia session has rallied on tech, the US rallied on tech themes. But we also got some data out of the US yesterday that maybe caused some people to stop panicking quite so much about no rate cuts, or maybe only a couple of rate cuts in the United States. But we'll talk about those linkages a little bit later. But tech certainly firmly in focus this morning.
It certainly is, and I think that takes us nicely into our next guest, who actively watches this far more closely than perhaps everyone else does. Magnificent Seven earnings, of course, as you mentioned, Anna, top of the agenda this week. Disappointing numbers as well, but the rhetoric from Elon Musk and Tesla as well. Attention now turning to Facebook's parent Meta Platforms. Those earnings due later today. That, of course, adds on to the Microsoft story, the Amazon story, the Alphabet story, you name it. We're going to dive into all of it. Joining us now is Kuei Wen, CIO for Equity Strategies over at Research Affiliates, where she, of course, supports the firm's systematic active portfolios and smart beta indices. Feels like a mouthful for the fact that you are watching the volatility in the tech space very, very closely. We talk a lot about AI and the momentum there and how to quantify it. I'm curious a little bit more about the cloud outlook in particular. There seems to be a catch-up in the cloud space. How are you thinking about that in terms of Microsoft versus AWS versus Alphabet?
So I actually think that with AI, the cloud is going to become more and more important. And I think that for all of these, for these three companies, it's just basically a growth market, right? So in general, I think cloud is going to make winners of them all. So I think that's the most important thing to think about there. It's not necessarily one or the other, but I really think that it's going to be all three.
Where does Apple fall into all of that?
Apple's not really been a big player in cloud, right?
Or AI, one would argue.
Or AI, but they're really more of a consumer technology company. And there's going to be room for growth in terms of AI applications for consumer tech. It's just we don't know what it is yet.
What did the 10% NVIDIA drop teach you the other day?
It teaches me that growth stocks have valuation multiples that are highly sensitive to interest rates.
Right. Okay. Are all of these...
It looked like you were going to say something else.
Yeah, there feels like there's a follow-up here. So NVIDIA's a growth stock. Are all the others growth stocks? How do are all the Magnificent Seven growth stocks? Okay, let's talk about Magnificent Five maybe. How do I differentiate which ones are growth stocks, which ones aren't? Which ones have actually got a kind of underlying story which actually represents fairly good value? Is NVIDIA the growth stock within the pack? Does it sit at the top? Is it most sensitive? That move came from nowhere in so many ways. As you say, the interest rate story kind of could have been the catalyst for it. Yeah, and let's assume we get more volatility in interest rates.
Sure.
What does that mean for this space?
So I actually think that NVIDIA is the true growth stock of all those, of all the seven. Yep. I would say that 5 of them are really quality stocks that has some attractive growth features. So if you really look at these stocks, the reason people like them is because they're highly profitable, they're very cash flowing, and they have business moats around them. I mean, there's really no substitute for certain Apple products, if we really think about it. Although in China there could be, but for the rest of us, there's a giant moat around that business. So those, I think, are truly quality stocks. They have some growth in them. But NVIDIA is the story where it's, you know, they have a business moat to some degree, but the growth expectations there are just massive. And so that is really a growth story.
And just to make clear, you have in your top 10 holdings, you have Microsoft, Apple, Meta, Amazon, Google. So a lot of exposure to these. We've got Meta numbers out later on today. Some people talk about AI. Well, a lot of people talk about AI when it comes to Meta, but I wonder if the AI story there is a lot less proven than the one at NVIDIA, of course. How do you see that AI story moving from tech giant to tech giant?
It's, you know, AI is going to be one of these technologies that could be very transformative, like the early internet, right? And the transformation never stays in one place. You have no idea where it's going to go. And it's true that it may be less proven, but that's looking in the rearview mirror. What we really need to do is look forward. And when you look forward, you know, the field is wide open. Lots of companies make missteps in all of these big transformative technologies. And I would say that the Magnificent Seven, they have the kind of business, the kind of balance sheet to withstand a lot of these setbacks.
Yeah.
You know,
we go through waves, though, don't we, of market tolerance for that kind of investment in blue sky thinking and moonshots and big ideas. And we certainly saw that with Meta. There was a lot of excitement around certain parts of that business and the headsets and the like. And then that was dialed back and a focus on the balance sheet and a maturity to the business.
Right.
So I wonder what's the mindset around Meta for investors now?
I think that investors do have an appetite for all of these companies to make investments in AI. And I do think that to some extent, they will be punished if their investments are done in a way that has no capital discipline. But so far, what we've seen from Meta is a commitment to better capital discipline and a willingness to experiment. So I think that would be a good thing.
But it's still at the investment stage at this point for so many of these companies.
Yes.
What's your timeline for getting actual returns?
I think the timeline is something. A lot of it will depend on how much investment is put in. Yeah. If you really think about the early internet, for example, you didn't get a big return on investment until essentially after the massive internet bubble crash, right? And in the years after that, you got a massive return on investment, as for the survivors.
But is this 99?
Yeah.
Oh no, I think this is at worst 1996. It's possibly even closer to 1993.
Let's talk about the liquidity picture then. If a lot of these companies initially got that early bid 4 years ago because of the massive piles of cash on their balance sheet, not to mention more exposure to the rates picture as well, how much of this is a liquidity play as opposed to a fundamentals play?
Are you talking about AI specifically?
Just the Magnificent Seven. They're all sitting on record piles of cash.
I actually think this is more of a fundamentals play because you look at the balance sheets, the profit statements of these companies. They are attractive companies. They should, you probably don't want to own 30% of them in your index, right? But owning all of them, I think, is a good idea.
Can I come back to the rate story? Anna Wong, our chief US economist here at Bloomberg, putting a note out late last night talking about how she sees the Fed evolving its rate strategy. Let me just give you a little kind of taste from what she says. If the Fed wants to get disinflation back on track in the second half, Powell will need to pivot again, basically reversing the December pivot, this time in a hawkish direction, perhaps as soon as the April, May 30th, May 1st FOMC meeting. This could spark a major and immediate market reversal, hitting growth in Q3 and Q4. You talked about the sensitivity of NVIDIA to rates. If Powell gets more hawkish, if the Fed gets more hawkish from here, what kind of amplitude are we looking at in terms of the volatility around some of these stocks, do you think?
Oh, I think that for the growth stocks, it could be massive. But I actually think that for the quality stocks, you'll see less volatility.
But NVIDIA is a growth stock, right?
NVIDIA is a growth stock.
So
Microsoft
what kind of amplitude?
Is more of a quality
what kind of
stock.
amplitude could you see in NVIDIA? Because a lot of people take their cues from NVIDIA in terms of how this market is set up.
Sure. I mean, I think if the Fed gets a lot more hawkish, then I think those multiples, the multiple right now is like 50 to 75 times earnings, depending on what earnings you're looking at.
Yep.
I think that multiple has to come down to something like, 30 to 50. It could be, it depends on how hawkish they are, but yes, that could happen.
Okay, so that'd be a substantial swing and
it would be a substantial swing for the growth stocks.
Certainly something to watch. What about the areas of AI that these businesses are going after and the extent to which they do and don't overlap? I mean, part of the story around NVIDIA for a long time has been about just nobody competing with it in the place that it operates.
That's right.
And yet there've got to be people trying now. This has been going on for a while now, and there are people in the street who talk about NVIDIA and know what NVIDIA is. So where are they at risk from competition?
I think they're at risk from competition in terms of people providing something for a lot cheaper, right? Because right now what's happening is everybody wants these chips. Everybody knows how to use these chips. They've got a business moat because they can teach people how to use their chips. But the chips become expensive after a while. And after a while, somebody might say, well, I can give you this chip and you can figure it out on your own. And at some price, right, that becomes feasible. Also, maybe there's just not enough supply for the amount of investment people want to make in AI. But in that situation, I think it's still a winning story for NVIDIA.
Okay, Quay, thanks very much. Thanks for joining us. Quay Wen, CIO for Equity Strategies at Research Affiliates, with her view on what's going on in tech right now. A big week for tech as we continue to track those tech stories and tech earnings themes. Coming up on the programme, we take a look at your stocks to watch, including in the luxury sector. Kering, the Gucci owner, slumping on TradeGate as it warns profit will plunge. We'll get details next. This is Bloomberg. Welcome back to Markets Today. We still have 17 minutes to go until the start of cash equities trading. The futures picture representing the sum of the parts of all of the corporate earnings stories that we've been through this morning. There have been plenty from the auto space to the luxury sector, but also representing a little bit of the macro read across from the US yesterday, the tech rally through the Asia session into Europe perhaps, although we had a bit of that, of course, yesterday. Let's talk about where we are on these markets. Joining us now, our Markets Live executive editor, Mark Cudmore, for a couple of minutes on the markets. And Mark, I want to get your risk-on, risk-off sentiment right now. I know you've been talking about, we're going to see a widening rally in stocks. That's been a theme we've discussed. But Bloomberg Economics increasingly nervous, and some other voices in the market increasingly nervous about whether we're going to have to see some kind of more hawkish pivot from the Fed. I wonder how you put those two things together.
Yeah, good morning, Anna. I didn't see this piece until Guy Johnson sent it on to me. I can't believe it because it obviously comes from Anna Wong, my favourite Bloomberg economist. Unbelievably interesting piece because the key point is that the December pivot by Powell was just what's really driven the real change in unemployment markets, inflation markets this year. And that, for me, was the big changing point for me. That's when I became really bullish for this year, and I remain very bullish. Now, the whole point of this article is that there's a risk that next week we suddenly get the hawkish surprise that derails things. And I guess that is a valuable point. And maybe next week will cause a painful kind of correction or pullback in stocks. It's important to emphasize, though, that any hawkish pivot from the Fed now will be in context that it's much stronger growth. It's for the best possible reasons. It's because the consumers continue to spend, the unemployment market staying strong, growth continues to be better than expected, and therefore that is the best reason for yields to go higher. So again, it'll likely be volatility rather than a major turning point.
OK, to the extent to which that offsets concerns around the height of rates, that'll be really interesting to watch as we go through this year. Let's talk about Japan. Really interesting piece out from your team this morning, talking about, yeah, sure, speculators may be short the yen, but that's not the whole market, and we need to keep that in mind as we look ahead to the BOJ and the possibility of intervention.
Yeah, look, the yen market is not short. There's not a net short there. CFTC speculators are short the yen, but they are mainly CTAs. They're momentum traders, and they're a small subset of the market. Discretionary traders are largely staying away because of the risk reward. Now, after this BOJ, people are going to want to sell the yen again. Now, they're hoping they're going to get to sell the yen after there's maybe been a hawkish surprise from the BOJ or maybe even intervention. But intervention from the MOF will not start a yen rally. If anything, it'll just provide better levels to resell the yen again.
It's interesting that we're talking about that yen move, which is really coming off a pop of the dollar, which again is related more to the yield picture that you're seeing in the States than anything else. Mark, don't go anywhere. I want to bring in a chart that caught my eye, which is kind of related to all of this. I'm nerding out a little bit from my M Live days and talking about this 2-year auction that we saw yesterday. Now, this is important and it gets a little wonky, so stick with me here. We're looking at the indirect takedown of that 2-year auction. And here's why I paid attention to this one in particular. Shout out to Cameron Kreis over in the States for pointing this out. You are seeing the biggest indirect bid for the 2-year going all the way back to June of last year. And that's what this kind of chart really shows. That blue line is what we saw yesterday. That yellow line is that kind of high that we've seen historically. Of course, this is a 5-year chart. The reason I bring this up, Mark, is simply because at least Cameron Kreis's take was the closer and closer you get to that 5% level, the market will still take down. There will still be a bid for the front end of the curve, even though cuts are priced out to 2025. What do you make of that demand that really nobody saw coming?
Yeah, I think that's right. I think that there's a kind of a structural shift to just collect higher yield in your portfolios when these bigger yields are on offer. And that's why, even though we're moving to a narrative of higher yields and that we're getting this suddenly going from a world where we are pricing more than 6 cuts at the start of the year to we might soon be talking about hikes again more seriously as the next move. Therefore, we've got more to move in yields overall. It's not becoming a dysfunctional move. It's not becoming a broken market. It's a structural, it's a kind of an orderly sell-off of the Treasury market because it's selling into structural long-term demand. And I think that'll remain the case even as yields continue to go higher.
Mark, let's talk about yields going higher and come back to the Anna Wong piece. Does the Fed need to get financial conditions tighter? And is the way that it needs to get financial conditions tighter by cracking the stock market?
It's a great question. So I think the first part of the question, financial conditions are essentially how the Fed can control the economy. It's not actually monetary policy. Monetary policy works via financial conditions, but Simon Flint, our colleague, has done an excellent analysis showing that it is really financial conditions that have the power here, not monetary policy itself. And in fact, one of the problems of recent decades is that monetary policy's impact on financial conditions has declined as the share of stocks and credit wealth in consumer portfolio has grown. So that's one issue we've got there. That probably leads into your second point. If they're going to get financial conditions tighter, they either need much tighter monetary policy because all these people are on long-term mortgages, because the power of monetary policy has shrunk since over the last 20, 30 years, and the equity power has grown, or they need to crack the stocks market. I guess what I'm saying is they don't have to crack the stock market, but if they don't crack the stock market, they're going to need to raise rates a chunk higher still. Either way, there's more that needs to be done from the Fed in some manner.
We live in interesting times. Mark, it looks like this year is going to prove an interesting one in the second half. We'll see what we get coming up and whether Anna Wong's call on this next FOMC meeting is going to be prescient. Our Markets Live executive editor, Mark Cudmore, thank you very much indeed. You want to get the themes, the ideas, and Mark mentioned plenty of them there that are coming on the MLive blog. MLive Go is the function on the Bloomberg terminal. Let's turn from the macro to the micro. Let's figure out what's happening with some of these single stocks. Joe Easton, what do we got?
Morning, guys. So we're starting with Kering, and the French luxury firm is set for a big drop at the open today as it warns of a slowdown across its business, particularly over in Gucci. We saw the ADRs for that stock falling almost 9% in US trading once this report hit. And we're going to bring up a quote from the CEO, which really summed up what's going on. The firm warning that while they already had anticipated a challenging start to the year, sluggish conditions, particularly in China, have continued, and that has exacerbated the downward pressure on the top line, particularly at Gucci. But it's not just Gucci. They've seen sales declines across the other brands as well, including Yves Saint Laurent, a 6% drop there. Obviously, Gucci down 8%, really the big number that stands out. The only real strong point was Bottega Veneta, that was up very slightly, and also eye care. But the other houses as well, this includes Balenciaga, down as well, down around 6%. So big drops across most of the main units for Kering today. And looking at a one-year chart, we can see that stock already slumping. It's down around 40% over the past year. It's underperforming LVMH and Hermes. The issue is they're not offering enough from the high-end defensive area, and also the aspirational buyers at the lower end not as excited with the new Gucci products not yet coming fully onto store, so that one could be a rough one today. Then we're also going to look at the Swiss pharmaceutical giant Roche. This company has a $200 billion market cap, and they are reporting a pretty significant decline in sales in the last quarter, down 6% to around 14 billion Swiss franc. They are still impacted by the decline in COVID-related products, so testing, that kind of thing. But they say this is the last quarter that they will see that impact. But also some of their oncology drugs over in the cancer space not doing as well either. If we look on the 5-year chart, here's the decline from the COVID peak, a big drop down there, and a number of analysts still sell rated on the stock, including big names like JPM, Morgan Stanley, Deutsche Bank, all of them predicting more downside, and potentially this feeds into that idea today. Then we're going to finally look at UK banks. Lloyds kicking us off with a number of reports coming out this week. It's not a great start. Lending income at Lloyds is suffering. This continues a theme of people switching their banks into higher paying accounts. Net interest income missing quite significantly. The mortgage market remains weak, of course, and the net interest margin down 27 basis points to less than 3%. We've got reports from Barclays coming out tomorrow, NatWest on Friday. This kicks us off. Not a great start. Lloyds could be weaker today.
OK, thanks very much, Joe. Our equities reporter, Joe Easton, there. And on the subject of Lloyds CFO on the call with analysts now saying that they expect the margin pressure to ease through 2024, which will be something really interesting to watch how that develops through 24, because expectations are on the move with regards to how many cuts we get from the Bank of England and therefore what kind of assumptions a business like Lloyds can be making.
I think Hugh Hill was on the tape yesterday.
Yeah, pretty hawkish.
Sounding, really quite hawkish. And you do feel like the balance on the MPC may be starting to shift in that direction in a fairly substantial way. In terms of what else, keep an eye on Boeing later. Boeing's going to be really interesting. In terms of what they're going to tell us. Obviously, we've seen some significant scandals around that business. The CEO is going to be departing. A lot of the senior management team are going to be departing. What are they going to tell us today? I'm going to ask that question in a few minutes' time to MOL, Michael O'Leary, who has a news conference in London today, the details of which I'm not going to give you. But I am going to ask him about Boeing, because they are waiting for their 737 MAXs, and that is going to impact their summer season in quite a significant way, the delays that we're seeing there. Who would he like to see as the new CEO of Boeing?
Does he go by MOL? Or
Everybody,
is that just you?
kind of internally.
That's how Guy knows him.
If you're part of the loop, you get to call him MOL. Is that it?
I've known him for a long time. Yeah, I think it's Michael O'Leary is quite a long thing to write out in an email, so I think a lot of people just kind of write it down as MOL.
Fair enough.
There's a lot of companies to watch at the Open then, Critty. Guy's off to do his thing around aviation. We'll be keeping an eye on Lloyds Banking Group, Heineken, Volvo Cars could be on the move. But overwhelmingly in Paris, we'll keep an eye on the luxury sector.
Yeah, it's the Kering story that's fascinating. I think on TradeGate, almost 8% decline that is indicated. And we're seeing that show up in perhaps futures as well, with the French index underweight there as well. We're going to dive into all that coming up on the Market Open. Stick with us. This is Bloomberg. Welcome back to Markets Today. A few minutes to go until the start of cash equities trading. We are seeing futures indicated higher. Eurostock 50 futures, FTSE 100 as well, but not necessarily in the French index, which is where perhaps you are going to see some pain. Virtually unchanged at the moment when you're looking at the futures picture. But Anna, Kering is just one story, one of the earnings stories that we have to process.
Yeah, absolutely. But it is such a big weight over in the French market. It might take a while to open the French market as a result. But it is interesting to see how far it does drop today, because we got a heads up about this, didn't we, some weeks ago? They'd already told us that Gucci was going to be, sales down 20% for the first quarter, and the China market is very much in focus here. But now we've got, what does that do to the bottom line? How does that drop down in the P&L? And so this China challenge over at this luxury name is really going to be part of the story. Of course, we'll keep an eye on the auto sector as well. We're post-Tesla, but we also got those numbers out of Volvo Cars. We could see a bit of lightness there, because even though they're talking about these ambitious sales targets, they did miss against some of the analysts' expectations. I mean, that worked for Tesla. They got a pop after hours, but we'll see what that does to the likes of Volvo Cars today.
And sticking with that tech space as well, we should mention that ASML has their investor day today as well. So what is the share reaction going into the Market Open? How are people positioning ahead of that major event? Then a couple of other ones as well. We had Reckitt this morning, Heineken as well. Heineken coming out with some pretty strong numbers. People are drinking, I guess, more beer than normal.
Apparently.
Apparently. So does that help? Is that, again, a China story, or is that still a U.S. story? How's the market feeling
I remember
about it?
reading an extremely well-informed piece earlier on this year that talked about how the summer's sporting calendar lent its way towards more beer consumption than other things. But this is certainly not talking my book. Reckitt, you mentioned this one. This could be one to watch. It's not been a great performer of late on the FTSE, so we will certainly watch that maker of all sorts as its like-for-like sales numbers come in better than expected. Lloyds Banking Group in focus, Roche in focus, a host of European corporates reporting this morning, and the overlay on top of that has been that tech strength coming out of the US latterly. Let us see where we open these markets then. The FTSE 100 out the blocks first, but is pretty flat. The DAX also flat this morning. Actually, the FTSE just getting a bit of a boost then, up by 0.3%. We're waiting for that French market to open up. Our producer rightly guiding us that could take a little time this morning, because Kering is such a big heavy weight on that market. So we'll be looking for any detail we get on the luxury space when we get an opening price on Kering.
Yeah, we are still waiting on Kering, but you are already seeing the likes of LVMH, for example, trade, and of course trade lower. It's already right off the bat one of the biggest index weights that you are seeing on the Stocks 50. To the upside, though, it seems to be a commodity-driven move to the upside. Of course, ASML is going to be your biggest index contributor when we're looking at the Stock 600. We are still waiting for more trades, a little bit more volume on that, but early on, you are seeing higher by about 2.5%. And the next ones you've got is Novo Nordisk, and then a slew of commodity names: Rio Tinto, Shell, BP, Total, for example.
Okay, yeah, there's a host of moves then. Let's have a quick look at where we are on those sectors. Basic resources does seem to be the best performing sector this morning, and so often this sector is one that takes its clues from the underlying metals. So we look to that, of course. But that sector up by 1.7%. On the technology space, you've mentioned some of those, and this picking up where we left off perhaps in the US and the Asia session. We see a bit of strength coming through on some of those technology names this morning. Texas Instruments We heard Tom at the end of the last programme talking about this one. Sentiment better there, so is that going to be something that boosts sentiment, you know, in the European low-end chip makers? But that's certainly a sector that we're watching then this morning.
We are, and we should also mention that Lloyd's that we were watching earlier on, now down about 2%. This morning. Again, it's bringing us back the question of the mortgage market, bringing us back the mention of these kind of net interest margins. I believe we have a slew of banking earnings tomorrow morning as well. What is the macro read-through into the micro that we continue to see? That's going to be, I think, top of my agenda. But alongside Lloyd's, you're seeing a lot of the banking stocks actually lower and under pressure this morning when it comes to weighting down at least the FTSE.
Yeah, absolutely. The banking sector is down by 0.2% this morning, so it's one of those sectors that's falling. We've got about 2/3 of sectors in positive territory and a third lower. Just worth pointing out a few of the moves that are on the stocks that we've been following this morning. Then Volvo Cars down by quite substantially this morning. It was down by 7% last time I checked. So the car sector very firmly in focus for us. That takes us nicely onto the US consumer and the state of the US economy more broadly, perhaps. US exceptionalism, the strength of the US economy has been something we've returned to time and again since the start of this year. It's reset expectations almost continually around what we get on the Fed. Let's listen to what Jamie Dimon had to say, of course, the JP Morgan CEO, around the US economy, around the US consumer, and the role that fiscal policy is crucially playing.
Even when we go into recession, the consumer's in good shape. But that doesn't mean you can fight off the effects of stagflation or something like that if it gets much worse. And so, you know, I worry that it looks more like the 70s than we've seen before. If you go back to the 70s, deficits were half what they are today. The debt to GDP was 35%, not 100%. And so part of the reason I think we've had this strong growth is the fiscal spending.
That was JP Morgan CEO Jamie Dimon speaking at the Economic Club of New York and ending there on that fiscal argument. Really good place to start our conversation with Daniel O'Keefe, lead portfolio manager of the Global Value and Select Equity Funds at Artisan Partners. Very nice to speak to you, Daniel. Thanks for joining us. And it's interesting, he was mentioning, Jamie Dimon there, mentioning the role that fiscal policy has played. And I know when you think about the US economy and the strong growth story we've seen this year, you think that part of the reason we haven't seen more effect from higher rates is because of that fiscal impulse. Explain a little more.
Yeah, I mean, it's very interesting. The market and a lot of business people are obsessed with this idea that we need to cut rates. But we're borrowing 6% plus of GDP on the fiscal side, which in my view is more than offsetting, you know, the restraining effect of the interest rate increases. So we've got the best performing economy in the world. We're doing very well. Why do we need to cut interest rates? And no one's talking about, you know, the fiscal side of the equation when we're thinking about the U.S. economy. That's clearly driving the U.S. economy and clearly driving inflation.
OK, so if we don't get, so if we only get a couple of interest rate cuts this year, or dare we say it, if we don't get any interest rate cuts this year from the Fed, you think stocks should be OK, sentiment should be OK, because it should be comforted by the fact that this is, to quote our colleague in the last hour, for good reason. It's because of U.S. economic outperformance.
Yeah, well, I don't think there should be any interest rate cuts. I mean, I think it's absurd. Maybe there will be, maybe there won't. I don't think there should be. We don't need them. You know, the economy is being driven by a strong consumer. It's being driven by government stimulus, and earnings are leading the way. So it's a healthier market, in my opinion, for the market to be driven by earnings rather than interest rate cuts.
Daniel, stick with us for 1 second. I just want to bring breaking headlines coming when we're watching Kering now. The stock is now officially open, down about 8%. And, of course, one of your major weights that you are seeing this morning, your biggest index, third biggest index contributor, of course, bleeding into LVMH as well. We're going to let a few more trades kind of help shake out, but just want to bring the initial pricing to our global audience. I want to bring it back from the macro conversation to that fiscal stimulus that you were talking about from the States. This has never happened in history. We've seen this many rate hikes match with this much profit growth. It's never happened at the same time. What happens when the fiscal impulse potentially abates in 2025, depending on who the next president of the United States is, or simply because of deficit issues? When does the market price that in?
Well, I don't know. I mean, there's absolutely no debate within the country, unfortunately, about restraining the spending, and it's unsustainable. It's clearly the major threat to U.S. economic dominance in the medium term. Trump never showed any fiscal discipline when he was president, and Biden has clearly shown none either. So I don't know what the end game is. Usually politicians only do what they only do the right thing when they've tried everything else.
Yeah.
And we're still in the process of them trying everything else. And so it will take a crisis.
So is that something you position for, though, or is this just not on your radar at all, given that we are just a couple months away, 8 months away from the U.S. election and about 9 months away from another debt ceiling conversation?
Investing is more about managing risk than about predictions, because predictions are almost always wrong. So we manage risk.
How are you managing that risk?
We focus on good companies and good balance sheets and valuations, and you don't get too optimistic and you don't get too pessimistic.
Okay. And with that in mind, let's talk about some of the big tech names, because a lot of tech names are reporting this week. I know Meta is one of the top performing stocks that you own. I think you still own, Daniel. What about, give us the best reason to pick this one over others, because a lot of people group either the Mag 7 or just the Magnificent 5 these days together. Why are you focused on Meta?
Well, I mean, we own Meta and we own Google, or Alphabet as it's called now. We like them both. They're great businesses. They're fundamentally very strong. The valuations are not particularly interesting at these prices, to be frank. But we believe in the businesses long term. We've been selling Meta recently. We trimmed it. It was a much larger position. We bought it significantly when it was down 70%, last year or in 2022. And as it's significantly rebounded, we've trimmed it. But we like the business. We don't particularly like the valuation here, to be honest.
And do you want the company to focus on, a solid balance sheet and the P&L, or do you want them to be more experimental? These sort of seems to go in waves and cycles, and we see periods where the market tolerates quite a lot of spend on R&D, and then periods where the business gets the message and pulls that back.
Well, I mean, they're flushing a lot of good money down the drain, on this whole metaverse, and we wish they would stop. Other than that, capital allocation is very good. I think the metaverse is sort of an embedded option, in the valuation of Meta. They're spending $10–15 billion a year that's generating no return. If they stopped, the valuation would look much more interesting. We hope they do, but that's an option you're not really paying for right now.
Right, so you're not too worried. What about spending on AI? Would you put that in the same box, or no, that's what they should be doing?
No, I mean, their AI is going to be a significant beneficiary for Meta. It's going to help make their advertising algorithm more effective. It already is. Before everyone was jumping on the AI train, Meta was talking about machine learning.
Yeah.
And using machine learning to make their advertising algorithms more effective. And it's working, and I think it will continue to work. I think they will continue to be a beneficiary of AI over a very long period of time.
We talked about Meta. Let's talk about Alphabet as well. You said you have a significant position there. Is the bet on Alphabet a consumer-driven bet based on advertising, or is it a business investment bet? What's the bull case for Alphabet?
Well, I mean, their biggest business is advertising, right, which is ultimately businesses using Alphabet to reach consumers. So it depends on how you want to look at that.
How do you look at it?
Well, I mean, it's driven by the advertising market, and it's driven by the continued secular shift of advertising towards online, and I think that will continue. It's a very, very strong business. And AI, people get very excited about AI, but the truth is the profits are, for the most part, on the come. And businesses like Alphabet and Meta, for example, will use AI as a tool to make their businesses more efficient, more profitable, and better advertising mousetraps. So that's going to happen over a very long period of time. People shouldn't expect AI to, flip a switch and the profits start gushing
Very
in.
quickly, what is that time horizon, though? Are we talking 5 years, 10 years, 50? For returns on that?
I think you will see AI play out over a long period of time, just as you saw the internet play out over a long period of time. So we'll be talking about it in 10 years for sure.
All right, Daniel O'Keefe there, lead portfolio manager of Artisan Partners, breaking down some of the nuances in the tech space as well. And as we talk about those heavyweights in the States, let's talk about the heavyweights right here in Europe. And I'm going to put my Guy Johnson hat or Guy Johnson tie on at the moment and explore the sensational 6 numbers, specifically because we're seeing the heavyweights actually underperform. The exception, of course, being ASML ahead of that big investor day. It's the only stock green on the screen this morning, higher by 2.4%. The LVMH story is interesting, though. That perhaps a read-through from the Kering pain that we are getting. The Kering shares down still about 8%. LVMH down by 0.6%. You've got that consumer bid there, and as well, Nestle down about 0.3%. I believe that later in the hour we're going to be talking about Nestle and the Unilever bid as well when it comes to that consumer. But again, it's that luxury read-through that I really have my eye on. Is this a one-day thing, or is there more to it? Which brings us nicely into exactly what Joe Easton has got his eye on. Joe, walk us through what's catching your eye this morning.
So we're going to continue with that luxury theme at Kering, because Kering getting absolutely slammed over in Paris, down 9% at the moment. The stock is trading at the lowest level since 2017, following that massive warning after the market closed last night. As Anna was mentioning, we already did see a report around a month or so ago saying that sales would be weak, but it is much worse than expected, potentially double-digit declines in earnings estimates. According to analysts, they're not doing enough on the high-end space like Louis Vuitton does well in, and also the aspirational buyers not got enough either. That's the view from analysts. Seeing some read across in some of the other peers. LVMH, you mentioned Hermes, Moncler. Moncler does have earnings coming up later today out of Italy. That could be an interesting one. But the moves, really not as much as we're seeing Kering. Hermes actually ticking slightly higher, potentially showing that this is really a Gucci story and an Yves Saint Laurent story, not so much a biggest read across on the market. But in terms of other read acrosses, we're going to look at chips, because these stocks are absolutely soaring today, the best performing sector by some stretch. Now, we've got Infineon up around 7%, the best performer on the stock 600. ST Micro doing well, ASML as well. ASMI, the chip machinery firm, had a strong update, and we also got a bullish report out of Texas Instruments after the close last night. All of those boosting the sector today. Auto chips seems to be the big thing out of Texas Instruments, not doing as badly as expected according to them. Then a quick look at some other earnings. We're going to start in the UK on these ones. So we did get Lloyds. This one was dropping, as you mentioned, at the open, down 2.8%. Another easing of net interest margins. Reckitt Benckiser, though, coming back up. The maker of household products doing well, did drop a lot recently given worries about their baby formula unit. That's one of the worst performers on the London market this year, but it's up almost 4% today. Temenos cutting its sales forecast. Interestingly, they say recent short seller report is causing banks to cut back on their software, showing the impact of that Hindenburg report that we saw recently. So Temenos down another 6% today. And Volvo Cars, a surprising weak one, because the auto sales, the EV sales, actually looked pretty strong in the last quarter, but some concern around margins, the initial take on that one. And Volvo is down sharply today, down almost 7% this morning. Just one deals news to bring you. All funds, disappointment for investors for this one. It's a fintech firm out of Amsterdam. They do data and analytics for the wealth management business, and they're scrapping a sales process, and that is dropping that stock around 8.5%. The worst performer over in Amsterdam. All funds really hit hard this morning. Finally, one morning call. UBS once again. It gets a second downgrade in 2 days. This time it's Citi who cuts the stock this morning. They go neutral from buy, and that stock slipping at around 0.9%. Citi say the valuation is too full following a recent rally, and capital worries still linger. So they downgrade that one, and UBS falling once again down over in Switzerland at 0.9%.
Thank you very much, Joe. Joe Easton there from our equities team with an update on what we're watching in terms of the market moves. There are so many companies on the move this morning. I just want to mention ASM International. I think actually Joe may have mentioned this one, but rising by 14% this morning, 13.7% as first quarter orders beat estimates, not to be confused with its other larger player within the same space, but that's where we are on the ASMI story in the chip space. Coming up on the programme, we'll stick with things Dutch. Beer volumes beat. The Dutch brewer Heineken reports higher sales for the first quarter. Details next. This is Bloomberg.
Okay, can we... This is Markets Today. We're about 19 minutes into the European trading day. You're seeing green across the screen broadly. The one notable exception being in the French index, of course, down about 0.3%. That is really a result of those Kering numbers, down about 8 to 9% in the intraday. But having a read through in some of the other luxury names, which again, as a function of being a heavyweight, is going to be weighing that down. We're going to bring you updates as we get them, as some of those trades shake out. I also want to bring to your attention another major market move, and this, of course, with dollar yen here. You are seeing that currency pair get very, very close to 155. I bring you the intraday here that is going to show you just a little bit of that drop that you are starting to see paired as we get closer to that 155 handle. I believe at 154.95, you saw a bid go into that currency pair. Again, we are on currency intervention watch. We've had commentary come out of Japan. That is something that they say the conditions are right for, but what line in the sand are they actually paying attention to? 154.88 on dollar yen at the moment. Let's go back to the earnings story and talk a little bit about one of the major stocks we are watching on trading this morning. Heineken has reported higher sales and volumes for the first quarter. The Dutch brewer, the first of the major European brewers to report. Carlsberg, for example, due out next week. We're joined now by Celine Pannuti, JP Morgan's head of Europe Consumer Staples, joins us this morning. Celine, a pleasure to have you on the program. Walk us through the Heineken story here. Some massive numbers when it comes to beer volume growth. 3 months ago when we had this conversation, it was a U.S. consumer resilience story. Is that still what's driving the Heineken growth?
So yes, Heineken today had very strong numbers, more than 4%. There was a bit of an impact from early Easter and some easy comparative, but still, clearly there is a recovery. And what we see is that the recovery is really broad-based across different regions of the world. So it's about emerging markets doing well. We see that India is strong, Vietnam is recovering, Europe as well is recovering. I think we have had an issue of elasticity last year as a lot of brewers raised prices, and we see that with less pricing, beer consumption is coming back. And I must say as well, Latin America was off to a strong start. So I must say it's a broad-based volume recovery, even if there was a bit of a one-off impact from some of the Easter timing I mentioned earlier.
Celine, what does that mean for pricing, though? Is Heineken now finding themselves in a more comfortable environment to hike up their prices and improve their margins?
Right. Prices have been increased quite a lot last year to recover cost inflation. We still expect pricing to be up low to mid-single digit in different regions of the world. So beer CPI continues to be positive. We don't expect really right now the focus to be necessarily on incremental pricing, but rather recovering that volume. I think we could be at the right spot this year where the company could recover margin because the cost inflation was behind them. We still see cost inflation ahead and they're pricing for that. But hopefully with the volume recovery kicking in, have the right balance.
Celine, good morning. I want to move our conversation to some of the other corporate earnings we're going to get this week. And I know Unilever is one of the companies that's very much on your radar. We had some stories out at the end of last week talking about Unilever, and that just one example of a company that's reining in its climate ambitions just a little bit, some of its sustainability ambitions, although crucially clinging to others. What's changing in investors' minds that businesses are making that choice? Clearly, we can see what changes in the politics, and in the United States, that's very clear. But what about what's changing for investors? What's the motivation for companies when they make that kind of decision?
Look, I think there is still quite a focus for the company to deliver on their sustainability ambition. At the same time, I think the pendulum probably has to be right. So in the case of Unilever, they were one of the first ones to come with a very ambitious sustainability ambition years ago, probably well ahead of the rest of the street. And I think new management really wants to focus on the operations. So it's, I think, not taking a step back from sustainability, but rather making sure that execution, the focus on delivering numbers on top line performance is there. And if you look at performance of the share price, clearly will be driven by the ability to recover top line growth. So I think it's more the company making sure that they have the right, the eyes are in the right ball at this time.
Yes, but given that they have a lot to focus on, Celine, I mean, is it the case that ESG leaders, so companies that have made a big fuss or talked a lot about being leaders on the ESG front in the past, are those businesses under pressure to close valuation gaps that exist across the Atlantic? Is that happening in the consumer sector?
Yeah, I don't really think that ESG leaders, there is a big of a valuation gap. So I can think about in my sector, a lot of companies that are doing extremely well on ESG and are highly valued, and others that have done well on ESG and are less valued. So I don't really think that necessarily it has an impact on valuation. As I said, what matters is effectively that especially for staple, we see that volume are coming back, and companies like Unilever need to make sure that they showcase that. We were just discussing about Heineken before. Volume recovery is going to be a key driver to share performance.
Celine, have you at all been talking about kind of the inflationary impact on some of the valuations of these stocks? Guy Johnson has been making the point often that you're starting to see a bid, at least in terms of the intraday trade, around some of these consumer staples that kind of looks very similar to what you've seen years ago when buying that commodity basket, buying that food inflation basket served as a hedge. In terms of some of these companies, does that affect the way they're valued?
I mean, clearly, what you've seen is that commodity had an impact on these companies. In fact, two impacts. Number one is that the high cost that they had to cycle, and the bigger impact, in my view, is the fact that they need to raise prices. We've seen unprecedented price increases in the double-digit range that had an impact on volume. And I think what we are looking forward in this year and next is to make sure that we come back to a more balanced delivery of volume and pricing. And so, yes, maybe commodities basket are as well listening as well in terms of if the total, cost prices have lessened for sure, even if still slightly positive for this year.
Celine, we are going to get numbers out of Nestlé as well, and I know that there's been some reporting recently that talks about an efficiency program there. What's going to be in focus for you?
Yeah, I would say the big surprise at Nestlé over the past couple of quarters has been that they had less volume performance than expected. I think consensus is expecting volume to be down slightly in the first quarter, but management has issued a guidance at the beginning of the year looking for around 4%. So I think the focus really is going to be, as we cycle maybe the last half quarter, how the company can come back to positive volume growth in the upcoming quarters.
OK, Celine, thanks very much. Celine Pannuti, JP Morgan's head of Europe Consumer Staples. Thank you so much for joining us. With your insights, Heineken, Unilever, Nestlé, the numbers keep on coming. Numbers hitting this morning. Criti's been talking a lot about Kering this morning, and the CAC 40 down by 0.2%, reflecting that weakness in the luxury space. Kering shares hit a 6-year low after a first half profit warning at the Gucci parent. We'll talk about luxury next. This is Bloomberg.
First-time buyers are 30% of our clients, which is a lot. We see a lot of Gen Z and Alpha. 35% of luxury consumers by 2030 are going to be Gen Z and Alpha. It's a hard number to believe, but it's the vibrancy, the vitality is huge, because each of those clients has a different set of reasons for why they engage with us. So for Gen Z and Alpha, they buy because they want to buy less and buy better. They want to buy because they see it's a financially wise investment.
That's the Chanel CEO, Lina Nair, speaking exclusively with Bloomberg's Francine Lacroix. And you can see that full interview on Leaders with Lacroix. That's at 9:30 p.m. tonight in New York, and tomorrow at 6:30 p.m. in London. So depending where you are watching. Let us stick with all things fashion and luxury and go to the Kering numbers. We have had another update from Kering on the extent of their travails, particularly for the Gucci brand in China. We knew some weeks ago about the difficulty they had in first quarter sales in China, but now we've got how this drops down to the bottom line on their P&L. And the news isn't good, and you can see the effect on the share price. Once again, then Kering down by 7.9%. This very much weighs on the CAC, which is down by 0.2% this morning, underperforming the rest of of the markets. Let's talk to Aurélie Husson-Dumoutier, who is a luxury and sporting goods analyst at HSBC Global Research, who covers this stock and the sector and can give us thinking around it. Very good to have you with us, Aurélie. Thanks for coming to join us. So I guess one of the things we were looking for today was a bit more detail as to what it is that's holding the business back in China and some visibility around that. What further visibility have you gained today?
Hello, good morning, and thank you very much for having me. I think the share price reaction that you see with Kering today is just the reflect of what the company has said yesterday evening at a call, saying, first of all, that current trading was not great and that April is actually below the performance of Q1, which implies that there should not be massive improvement in Q2, which we were all more or less expecting a little bit. And the second thing is, of course, as you mentioned, the fact that the indication that they have given for H1 and H2 profits are leading to massive downwards revision from the consensus we have estimated probably around 15%. So this is true that Kering is currently trying to turn around the Gucci brand at a time when the Chinese market, well, the Chinese customer cohort is pretty lackluster. So this is why it's probably going to take more time than originally anticipating.
Yeah, how do you define, Aurélie, how do you define the part of the China market that is coming under this pressure, that is causing these headaches for Gucci? I was reading in our story earlier on one analyst saying, suggesting really that it's too expensive for some consumers and it's too cheap for some consumers, believe it or not. So where does that leave a brand such as Gucci?
This is true that most of the luxury houses have passed on massive price increases during the 2019 and 2023 period by roughly 50%. So that is true. That was one of the reasons why the aspirational consumers was actually flying off the market. So now we tend to see that the richest part of the consumer is still there, but it's probably not enough to drive the volumes for all the brands in the industry.
Aurélie, we should mention that I believe you have a €400 price target on the stock at the moment. When we're talking about visibility into the recovery story for Kering, what do you need to see?
Well, we need to see one thing, which is sales picking up. And considering the comparison base that becomes much easier in H2, we hope that can happen. Actually, probably, maybe not in Q3, but at least in Q4.
And when we're bringing it back to kind of the China consumer story, Anna already touched on this, but where does the U.S. consumer fall in here? Can the U.S. consumer make up the gap?
Unfortunately, no, because, the Chinese consumer remains the number one consumer. And that is true that the U.S. has entered a path of more normalized growth, even if in some cases it was actually negative in 2023. So there should be a recovery, but not enough to compensate for the weakness in the Chinese consumer. At HSBC, we expect 7% growth for the luxury market in 2024, and we expect 7% for the US and 4% for mainland China.
Let me focus in a little bit on any read across into other names then, or at least we've talked about what's going wrong at Gucci and the difficulties for Kering. Does this have read across into other businesses, or are they all just so specific, so idiosyncratic that that's not the case?
This is actually kind of a one-off because obviously Gucci is in a turnaround phase. But if you look at LVMH numbers that happened a few days back, the growth in the fashion and leather division was only 2%. So it's also showing, because of high comparison base, that we are entering in a normalization phase. But if we think about Hermès, that should be out tomorrow, consensus expects 15% growth, also because Hermès has been maybe a bit more reasonable during the COVID years and has not increased prices as much as the other. So there is kind of a catch-up effect. So Hermès is embedding a price increase of 8 to 9% that is hopefully and obviously going to help the sales momentum.
And what kind of difference can the management team at Gucci make here, Aurélie? Sabato De Sarno, of course, appointed in January 23. And you hear positive things from management about how new collections are going down. What kind of self-help measures are they taking?
They are spending a lot more on communication, and that is true that the Sabato De Sarno have had kind of a warm welcome from the consumers. The only thing is that they only represent 7% of sales today. It should ramp up to much more by the end of the year, but it seems that management has taken all the actions in order to help the Gucci brand to be reignited.
Aurélie, when we talk specifically about kind of, I'm just looking at your valuations here. When you look kind of the bottom line of Kering in particular, I'm curious why you haven't lowered the price target more.
Well, I must admit that we have had a lot of surprises yesterday in terms of, notably in terms of profit. So leave us sometimes for all the analysts to adjust their numbers.
Fair enough. Aurélie, we look forward to having you back when you upgrade, or I should say update the analysis. Talk to us then a little bit about the valuation story, because when we continue to see the kind of bid into some of these luxury names, it seems to be largely a European catch-up trade to the U.S. I'm curious what that does to the valuation of luxury as a sector. We'll put Kering to the side for a second. Do you see that kind of outpacing perhaps some of the fundamentals?
Well, when it comes to the luxury goods sector, in terms of stock performance, is entirely linked to sales momentum. And as Q1 and Q2 are going to be pretty lackluster, with some exception, we discussed that, we don't expect the luxury sector to massively outperform indexes until H2 prospects are in sight. So this is why at HSBC we have kind of a cautious view, and we believe valuation are a bit too stretched right now, considering the weak sales momentum.
OK, thank you very much for joining us. Aurélie Husson-de-Moutier, luxury and sporting goods analyst at HSBC Global Research. Thanks for being with us. So global trade very much in focus there. Global themes around FX in focus over in Indonesia. Bank Indonesia raising its benchmark interest rate then, Chrissy, to a record high, moving to support the currency, basically. And this was not expected. Only 11 out of 41 economists saw this coming. This decision is lifting the rate to a new high, and it's in response, it seems, to changing expectations around the Fed, what the strength of the dollar is doing to this particular economy, and what Middle East global geopolitical tensions are doing to the strength of the dollar as well, and all that pressuring some of these Asia FX.
And we've continued to see that as well. I'm putting on my Guy Johnson tie again here as well. Our currency, your problem. That continues to be the theme. You saw it even in the Japanese story as well. We're continuing to be on currency watch there and for intervention, right on the cusp of that 155 level. Do you start to see that show up in the likes of Vietnam, the Korean won, et cetera? You've already seen that commentary come out from Asia.
Yeah, absolutely. So certainly we'll keep an eye on that. The expectations around interest rates shifting quite rapidly, it would seem, in 2024, both from the emerging market side, as we've seen there in Indonesia, but also in the developed market side as well. Coming up, Chrissy, we're going to be talking about China.
We are. We're specifically talking about the geopolitics there. China accusing the United States of sending the wrong signal. An $8 billion aid package for Taiwan. We're finally getting that Chinese response. All as Anthony Blinken heads to China, and a TikTok divestiture may be hitting Biden's desk as soon as today. More on that next. This is Bloomberg.
These two ships are from the Chinese Coast Guard. And the ship they're targeting with high-powered water cannons is a Philippine supply vessel.
We've been here for almost 3 hours, and the situation has gotten more tense.
An international court says the Philippines has the right to extract resources in these waters.
Since the threat has grown, we must do more to defend our territory.
China doesn't see it that way.
面对非方船只的强行冲闯，中国海警不得不采取必要的执法措施。
It's the 6th time in 8 months this kind of incident has happened. and it's a growing problem for the world. The U.S. and the Philippines have a mutual defense treaty dating back to 1951. And the circumstances that may trigger U.S. involvement have become more clear recently.
Southeast Asian leaders are anxious over the prospect of a war between the U.S. and China, two partners that they depend on dearly, whether it be over Taiwan or in the South China Sea.
Second Thomas Shoal is the most dangerous flashpoint today. This is truly a crisis waiting to happen.
China and the Philippines have wrangled over control of these waters for decades. But in the past year, tensions are close to the highest they've ever been.
Bloomberg Originals there, taking a closer look at the escalating tensions in the South China Sea. And just as we, of course, cover that geopolitical tension in that part of the world, we are getting lines out of the Chinese Foreign Ministry. Their daily briefing actually really targeting the EU. They're saying that this is, of course, coming from the spokesperson, urging the EU to stop smearing China, saying that claims of Chinese overcapacity are a, quote, protectionist excuse. And they hope that the EU abides by World Trade Organization rules, committing to that open market and stop trying to suppress those Chinese firms. So again, some very strong language coming out of China, targeted, of course, to the EU, given some of those rising tensions around the world with China and the rest. Let's talk about China in the context of the United States here. They're saying that the U.S. is, quote, sending the wrong signal after the Senate approved an $8 billion aid package for Taiwan as a part of the entire $95 billion national security package. It also comes as the U.S. Secretary of State Antony Blinken visits China this week. Bloomberg's Bill Ferry is, of course, in Singapore monitoring all of this. Bill, the timing here is really crucial because just as that potential TikTok divestiture bill hits Joe Biden's desk, Antony Blinken trying to be a good diplomat over in China. What could we see out of this meeting?
Well, yeah, you have Antony Blinken returning to China after Janet Yellen was just there and after U.S. and Chinese military leaders have finally resumed some communication. All of that talking going on between the two sides doesn't mean that the problems have gotten any easier. You mentioned the TikTok bill. There has been talk about the threat of new sanctions against Chinese banks who have been funding or buying oil from Iran. You've got continuing U.S. pressure on things like semiconductors and Chinese suppliers doing trade with Russia. So there's a whole range of really difficult issues that haven't gotten any easier. And I think it's likely that Blinken landing there after this TikTok bill probably gets signed by President Biden at some point this week. It's going to be some very difficult conversations he has with the Chinese. But compared to where we were, say, a year ago, when there were still difficult issues and no conversations, I think people on both sides are glad to at least have talks restarted.
Right, and so we find ourselves in this sort of dual track, don't we, Bill, as you point out. On the one hand, there are lots of visits happening and there's lots of interaction, and that's got to be a good thing. And Biden and Xi have met a couple of times since the balloon episode of a year or two ago. On the other hand, there are all these sticking points, and the detail is probably important there. Can we expect any breakthroughs in ties in the coming months?
I think major breakthroughs are unlikely. I mean, we're in particularly looking at the U.S. election calendar. I think the Chinese government knows that it's going to be a bumpy year. Anti-China sentiment is strong in both political parties in the U.S. It's one of the few things that unite them. So I think they're going to look for progress as they have more recently in kind of maybe less high-profile issues, but certainly, you know, the talks about the fentanyl trade, the precursors that are often manufactured in China that make their way to the U.S., working on things like that, working on climate change. But I think some of these really high-profile issues are going to be very difficult to resolve.
Bill, I thought what was interesting in some of this kind of national security package, we talked about the TikTok a little bit, divestiture, but there was another piece in the Iranian sanctions, the broader Iranian sanctions, that talked about Chinese infrastructure, financial infrastructure, actively getting targeted as a part of the stricter enforcement mechanisms. How does that work? How is that being received in your part of the world?
Well, there's a lot of there is concern about, you know, the scope of these sanctions. They would, in theory, target Chinese banks or the financial system involved in the purchase and trade of Iranian oil. There is a political context to all this, though, of course, and that's The Biden administration doesn't want to see oil supply diminished. It doesn't want to see prices rise at the pump. So I think there is this built-in expectation that President Biden would use his authority to waive any restrictions, at least in the short term. I mean, when we saw that bill make its way, there was no corresponding spike in energy prices, oil prices. So I think that is that's the bet the market is pricing in and that policymakers are pricing in for now.
Bill, thanks very much. Bill Ferry's there with the latest on US-China tensions and conversations that are set to take place with Anthony Blinken making his way to China, as we've said. What else are we watching for today? Well, 10:30 a.m. UK time, we'll see Germany auction 10-year bonds. That'll be 4 billion euros worth. 1 p.m. London time, ASML's AGM begins. We'll come back to that in just a moment. Rishi Sunak is going to be continuing his tour. He's been in Poland. He's going to be in Germany. Anthony Blinken arrives in China, as we were just discussing. And later, Chrissy, we get plenty of earnings coming through. Over in the United States, we have IBM, Boeing, Ford Motor Company, Meta Platforms. We've had some very outspoken commentary on Meta today from some of our guests, just at the top of this hour, in fact, talking about the extent of tolerance that exists for these businesses to spend money on moonshots, in the words of Alphabet, at least.
Yes, and Daniel O'Keefe specifically saying that this is money that he wished that the company would stop spending. Again, his words, not ours. I think what's also interesting is that this kind of meta story comes in line with the TikTok divestiture story in the States. Geopolitical tensions are kind of running through a lot of this, including for right here in Europe with ASML.
Yeah, absolutely. So let's focus in on that. ASML will hold its AGM today. The Dutch chip machine giant has grown into one of the tech industry's most critically important companies. CEO Peter Wenning will pass on the baton to Christophe Fouquet after more than a decade at the helm and really growing this business, this big maker of lithography machines. But there are challenges ahead, not least US efforts to curb technology being sold to China. So let's delve into some of the detail that ASML is facing then. Bloomberg's Sarah Jacobs has details for us. Sarah, good morning. What legacy, let's deal with that, what legacy does Peter Wenning leave behind then as he retires from ASML?
Good morning. Yes, in the over 10-year tenure of Peter Wenning as CEO of ASML, the company's expanded to become Europe's most valuable technology company. ASML shares have risen nearly, 12,000% over this period. The company's, dominance in this sector can be attributed to its state-of-art extreme ultraviolet lithography systems, which it, launched in 2016. It's the only company that makes the equipment that's needed to, produce the most advanced chips that power everything from smartphones to, military technology. And just to remind you, these EUV machines are very expensive. They cost more than 200 million each. They're size of a bus, and their customers are everybody from TSMC to Samsung, who depend on their technology.
In terms of depending on that technology, it feels like ASML and, by extension, the Netherlands is kind of stuck between the two global superpowers of the world. You were alluding to that. I think about something like 30% of revenue comes from China for ASML. What is the new management or the successor? How might they deal with those tensions?
Yeah, so ASML has been caught in the crosshairs of the U.S. government's, push to block China's ambitions in the chip-making industry. The Biden administration pushed the Dutch government, or urged the Dutch government to introduce restrictions on ASML's, the exports of ASML's second most capable machinery to China, and that took effect on Jan 1st. ASML has never been permitted to sell its most advanced extreme ultraviolet lithography machines to China. So Fouquet, the successor of Peter Wenning, who will now come in, will have to navigate these sort of tensions between Washington, D.C. and Beijing, and while maintaining sales in its largest market, China.
And let me talk a little more about the identity of this business, I suppose, Sarah. ASML was considering expanding outside of the Netherlands, such a Dutch success story. But because of concerns around the business climate within the Netherlands, there had been some voices suggesting that maybe this business needed to grow elsewhere. What's the latest on that?
Yes, so ASML depends very heavily on international talent. The company sort of threatened to expand outside the Netherlands because of issues with, grid congestions there, because of the shrinking of the tax benefit for expatriates, workers, and proposals to stem the flow of international talent into international students into the Netherlands. So they've had all these issues, and the government sort of hastily put together a task force codenamed Beethoven earlier this year, where they tried to make sure the Netherlands the ASML remains within the Netherlands. And earlier this week, ASML came out and said that they had signed a letter of intent to, to explore the idea of expanding within their home region of Eindhoven. But of course, the final decision, they said, will depend on a lot of so-called crucial points which needed to be ironed out.
And we should make the point as well that this also comes in the backdrop of the Netherlands and the Dutch political parties really pushing back against immigration generally, which ASML, to your point, Sarah, has said they're really eating into how much they can expand in terms of actual talented labor. Bloomberg, Sarah Jacob, we thank you so much for bringing us that crucial context as well. Anna, that seems to be a theme around the world as well. Is where does the labor part of the equation factor into not just expansion for the likes of ASML, but the labor story in terms of the Fed, the ECB, et cetera?
Yeah, I mean, immigration, a hot political topic in many places. Tight labor markets, a hot topic economically in many places. But using the former to fix the latter is politically difficult and challenging in some places. So certainly that is something that we have in focus. The chip story then, that rolls on. We've seen the influence of Texas Instruments. We're going to be keeping an eye on this AGM taking place at ASML. Other sectors in focus as well then today. Aviation in focus, because Guy has gone on his way to talk to Ryanair's CEO, Michael O'Leary. We'll leave the details of that for later, but we're going to bring that conversation to you a little bit later on today.
Yeah, talking a little bit about, again, where are the capacity shortages? Where are kind of the Boeing effect as well, I imagine will inevitably come up. And does that move the market in the way that, for example, some of those chip stocks were just moving? There's a lot to digest there when it comes to what is actually moving this market. Does the monetary policy matter? Or are we set? Have we kind of locked ourselves into a couple of weeks of micro earnings chat?
Yeah, I mean, we have that to look forward to.
Yes, we do.
If that is what floats our boats collectively, then we're in for a good time, because that is perhaps where the focus will be. But on the we won't lose sight of the macro, though, because, of course, we've got the BOJ coming up, and we have this ever-shifting landscape around Fed rate expectations, and what that does here in Europe, really interesting to watch.
And plenty of banks reporting tomorrow, which will kind of marry the macro and the micro. I guess that does it for markets today. The Pulse is up next. We're going to have some really interesting conversations. We were just talking about the airline space. The chip rally continues. All of that getting covered in the next hour. Stick with us. This is Bloomberg.